So I'm gonna set some music, but the stream won't be able to hear it because I don't know. Every time I try and set music, it always never works, or it's too loud. I don't want to try and mess with it. So the music will only be on my end, fortunately. But for the sake of those wondering what I'm listening to, I'm listening to Lo-Fi Rain in the City. So, anyways, so what I wanted to talk about while I'm eating my ramen is the yield curve. Oh, I just realized my mic was pretty far away. Let me pull up the chat. Okay, somebody joins. So everything's a little slow right now. I'm trying to bring up the chat. Oh, hello ODST, thank you. Yeah, I'm not really worried about how many subscribers. I think when I got 100 it was pretty big. But I realized that, if my channel really does grow, when I'll get 1,000, like 100 will be nothing. And 10,000, 1,000 will be nothing. And so like, I don't know. I don't want to focus on the subscribers. It's nice though, but it's not why I do it. So I need to remember that. But anyways, I wanted to. There was some pretty alarming things. This today at least. My mother this morning, started telling me that the stocks were going down, and when my mother talks about the markets, it's usually when there's a lot of news and everybody's talking about it. And so the fact that my mother talked about it kind of tells me that there is this a lot of panic. And if you go out on YouTube and you go in the news, you'll see everybody's talking about the markets. Japan, the Nikkei, that's Japan's market. This is Japan's market. Today, or was it? It was either Monday or one of the days, probably Friday or Monday, had its worst day since since 1987. I think it was today. So 11% drop. Worst day since 1987, which is pretty huge. So there's a lot of fear and panic in these markets right now. I'm seeing a lot of people start to say that we may get a head and shoulders pattern, where they're taking this high in 2024, they're taking this high over here, and they're saying that, we're going to get a head and shoulders pattern. We're going to come up, or actually they may even be doing that using the 2022 high. And if you don't know what a head and shoulders pattern is, I'll show that in a sec. Yeah, some people may, I bet you some people are probably taking this high as a head and shoulders pattern. But the head and shoulders pattern is, let me bring up an image. I don't believe the head and shoulders pattern is going to occur, but this is sort of the narrative that's being printed, is that we're going to get a head and shoulders pattern, and then you're going to see this neckline break. This neckline is actually my liquidity. That's when I'm buying underneath that level, right? And it just so lines up with what I'm seeing a lot of these retail RICs kind of paint, where they're looking at these highs left in over here, or I'm pretty sure they're just looking at the recent high, March. A lot of these people are looking at that, and so they're kind of drawing this neckline here. But as you know that, if we do start to draw lower, this is going to be a liquidity sweep, so we might kind of retrace a little bit, or chop sideways, and then have one more run as a manipulation lower, making people believe that we have a head and shoulders pattern, and then we're gonna get a really nice run up. I believe is my base case for the rest of the year. But before, I don't want to talk much more about the stock market. I mostly want to talk about the economic indicators that I've been looking at. So let's go to my economy. Okay, so oh my god, no, interest rates. It's a little slow. Okay, it won't change. Maybe it's the Wi-Fi I'm on. Yeah. No. Okay. So yeah, these rates have been at 5% for quite a bit. I don't believe they're coming down. But the certain narrative that's being printed right now is this carry trade. So I'm going to read something that my friend sent me. And he is a major in economics. So you must think he knows what he's talking about. But it's not him, it's somebody else is talking about it. So the yen carry trade. Japan has been offering very low interest rates for a long time. Investors borrow money in Japan at these low rates and invest it in other countries where they can get higher returns. This is known as the yen carry trade. The same trade is playing out in the dollar. When the dollar had really low rates and now is at high rates, you're seeing this unwinding of the carry trade. Inflation and interest rates. Recently, Japan has been facing inflation, which means the prices of goods and services are going up. To combat inflation, the BOJ might decide to raise interest rates. Now, I don't believe they're going to raise interest rates much further. I believe that they're going to pivot and they're going to start dropping them again. The impact on carry trade: if the BOJ raises interest rates, it becomes more expensive for investors to borrow money into their loans in Japan. How the collapse market, short squeeze. And then you can read the rest. But, the flight safety is another one. In times of market uncertainty, investors often move their money into safer assets like U.S. Treasuries, gold, and U.S. dollar. All right, so this is where you're going to see bonds pick up. Bonds are going to get a lot more attractive. You already see the bonds are, the yields are dropping and the prices for bonds going up because more people are buying them, right? And so one more image I want to show. And my friend sent me, thank you to him, from Federico Torre. The yen rate at 0% for many years or less. Investors could borrow yen close to 0% and oftentimes get paid to actually borrow in yen and buy U.S. Treasuries for 5%. It's free profit, right? Until the rates go up, which means that they're going to be paying more for that loan that they're borrowing at 0% interest. All right, if the rates go up, now they're gonna have to pay more, and then the price of their loan is gonna go down because they'll pay less. So they may get margin called if they need to sell and repay that loan early. USD rate goes down. So this is this belief that, I don't know why he did 3 and 2, but this is this belief that the US dollar rates are going to go down in September, right? And there's almost like 100% chance is what the market is saying, like 90% chance rates cut September. Traders are now 100% certain the Federal Reserve will cut interest rates by September. There are now 93.3% odds that the Fed's target range of federal fund rates will be lowered by a quarter percentage to 5.25% in September. And some people are even making the case for 50 basis points, which is crazy. But they're not going to cut the rates. Everyone believes they're cutting the rates, but they're not going to, just because everyone believes that they're cutting rates. And this is giving the impression that these rates, because they're cutting, everybody's buying and doing everything they would normally do if they had actually cut rates. So they don't need to cut the rates because they're getting all the effects they'd have by cutting the rates without even doing anything. Okay, so the rates will not go down. And then the yen are going to start dropping rates again. Okay, this is just to create panic. We're also in a seasonal tendency where prices tend to go down. So I'm not worrying about anything. If I had money to put into stocks, I don't put my money in the stock market, but if I chose to go that route, I'd be adding right now. I'd be buying more. So I'm not worried. Like, I think we may go a little bit lower, or move sideways, but still. All right, so then the yen USD conversion rate goes down. USD stronger, higher pay back the yen. All right, so that would make he's making the case that the USD goes down and it would be weaker, and the yen goes up. So USD would actually be weaker, easier to pay. No, yeah. Well, I don't know why he's saying USD stronger, but yeah, it would be harder to pay back the yen. So this is this kind of scenario that is being put forth where, this may cause margin calls and a reaction in the global economy. I think that we may have the same sort of thing, but later down the line for different reasons. So if I go to, before I talk about the economic indicators, one more thing. If I go to USD JPY, right, this guy is going to 200. And you saw when we got to about 150 and back here 160, we have these big spikes down. 160 is a very big level that Japanese are trying to hold. And so this is kind of like, all they're really doing here is they're trying to delay the rate at which the yen runs up to 200 or wherever higher levels it wants to go to. And this is USD against the Japanese yen. So, if you want to price it in US dollars, this is priced in yen. So it's actually weakening if it goes up. If USD JPY goes up, the JPY is going down. So you could look at it to get a better representation like this. And so you see the yen is, falling quite a lot. Now it's going up because Japan started to raise the rates. But again, I think that this is just a tactic to introduce fear and liquidity into the markets, and again add to the fuel that the Federal Reserve will need to cut the rates, just so that the rich can take the other side of the trade. But if the yen starts to go up like this, we're gonna actually compare it to the NASDAQ. So we're gonna go USD JPY. Let's be, I don't know, where is it showing up? I can't see it. We'll do a new pane. Okay, so you see the yen started to drop or strengthen as the markets did the high right there. And so this is showing you that Japan has a big involvement in US dollars. So if the yen starts to raise its rates and people now all of a sudden can't do this carry trade anymore, they're going to start to sell their dollars, their investments in other countries, and then pour it back to the yen. This is exactly what was described in the image I showed you in the beginning. So this is exactly what's going on. Right? People are in other investments, foreign investments, and then going over to the yen when the yen starts to raise its rates. But the capital is just going to flow right back in when the seasonal tendency is going to be over. And then we're not going to get those September rate cuts. So I'm telling you, next month, we're not getting those rate cuts, and people are going to, if we get the rate cuts, I'm completely wrong, and we have a big crisis and a recession. That's the only way we're going to get rate cuts. I want to emphasize that, if unemployment rises to like 6% or 8%, and we have severe inflation, and there's a crisis, and people are losing homes and losing jobs, and everybody's messed up situation, then okay, I can see how they'll have to cut, right? But they're not going to do it until that happens. They're not going to get a soft landing. They're going for no landing. They're not even going to do anything. They're not going to move. They're not going to hike. They're not going to cut because they don't need to. Everything's going the exact way they planned on. If you read the speeches in 2018 and 2020, August 2020 from Powell on monetary policy, and 2018 by the President of the Federal Reserve, James William, on monetary policy, everything is going exactly the way they planned to. So they're not going to cut rates. And when people realize that the dollar is going to stay high at these rates, this insane volatility because of this uncertainty behind the monetary policy is going to keep up, and markets are going to go right back up ripping again. So this is plot that people are panicking. And another thing too is I believe we've seen so many crises that majority of people expect these crises now. I go on the media and I see a lot of people that are bears get invited to these news, and people saying we're going to get a big market crash aren't getting laughed at like they used to. It's pretty it's still a pretty popular idea that we could have a market crash, and so that tells me that makes me uncomfortable actually going forward with that market crash, right? But again, things are heating up. It's true, things are heating up. It's looking like we may get a crisis, but I just don't think that they're going to get as bad as people make it out to be currently, or to get bad, right? So now we're going to go to the economic indicators and sort of what I want to talk about before I went on a big rant. I think the rant was all relevant though, so it's not like I'm not ranting about things that don't matter, like my ramen, which I'm just gonna take a bite. Okay, so this is the yield curve. Alright, no, this is not the yield curve. First of all, the VIX. This is insane. We had volatility like this in 2020. We probably had volatility like this in 2008. And so it's evident that, this insane move higher is obviously, we've had these sorts of moves before. So obviously this is still pretty alarming, but I don't think things are going to get this bad yet. We've had pretty big moves before where nothing really happened. But obviously we're going to see a little bit of, we've never really been in a situation like we're in today, really, too, where you look at the monetary policy the Federal Reserve has right now, where there's this belief that we're going to get rate cuts, but we're not going to get rate cuts. Again, if I'm wrong, then I'm wrong, but I'll accept that I'm wrong, but I just don't think we're going to get rate cuts. And so this is going to come all the way right back down and create even more volatility if we don't have rate cuts. This uncertainty about rate cuts is exactly why we have so much volatility, and it's never really been this way before, right? We've never had a situation so much in the past where the rates were near zero. I think we did in the 80s, where we just put them up to 20%, and we had stagflation. But this is basically what's happening, right? Because even though the rates aren't at 20% like they were in the 80s, we have 3 times the deficit, and so that I heard actually impacts the sort of levels the rates are at, because they're at 5% with 3 times the deficit. It's giving much more an effect, the fact that the rates are at 5% than if they were at 20%. Back when we had less deficit. But anyways, and I believe just like in the 80s, they kept the rates up at 20% until people lost more homes. People were protesting the Federal Reserve to bring the rates down, right? And it's like almost basically the same thing that's happening today. But this is what I want to talk about. The 10-year yields, and you take the difference between the 10-year yield and the 3-month yield. Or actually, before I talk about that one, I'm going to talk about, well, I mean, I've talked about this many times before, but I'm going to talk about the 2-year, because this one hasn't crossed over 0% yet. Let me actually go on the candles. So this one is indicating that, whatever crisis is going to happen, and this one is much more accurate. When you take 10-year duration of yields and you take the 3-month, this is basically when it's negative. It's telling you that the 3-month gives you a higher yield than the 10 years. And that doesn't make sense, because if you're giving your money to the government for 10 years, you best be expecting a higher coupon rate than if you were giving your money to the government for 3 months. But no, just because short term, there's a lot of risks. When it goes back to normal, that's when a crisis happens. March 2020. Over here, July 2007, mid 2007, that's when the 2007 housing market crisis happened. Back here in this one was more of like 2000, end of 2002, I think it was like July 2002 or early 2002. And then there was a Gulf War in 1990, which caused a recession. Okay, and this was a stagflation where we went up and down the zero, and we stayed and consolidated beneath that 0% quite a lot. And it's looking the exact same. So we just kind of dipped in there, and we're starting to consolidate in this. So I still think we have a couple more months, maybe even another year, before we cross above zero, and we really see people start to suffer. But I'm telling you, these rates aren't going to go down until people suffer and lose homes, and we're not seeing that. We're seeing some people, they get jobs and then they quit their job, and then when they need more money, they get another job. Like, there's a lot of demand for jobs right now, there's a lot of supply of jobs. The reason why unemployment is so high, and it's not alarming, is because the amount of immigrants that were in the country that came from Mexico and other parts of the world. And so this is creating this big supply of workers, which doesn't meet the job creation. It doesn't mean that there's no job creation, or it's at dangerous levels. There's still good job creation if you have the necessary skills. But you have this in the 80s. You had the rates go all the way up to 20%, right? They topped out at, what does that say at the top? 7? What? I don't know, but it's 20%. It says 20.04, whatever. But high is 20%. So they put those rates up. Let's see for how long. Maybe it will. Looks like only for a month. They put up to 80%, and they dropped them all the way back down to 9, and they put them all the way back up to 8, and a year later to 20%. So they had this high rate environment above sort of 10% for what is that? November 78 to, or we'll say October 84. So about 6 years they had these super high rates. Okay, and then the bulk of it was from June 79 for about 3 years to June 82. Okay, so this high rate environment just started. Okay, you take these high rates, 2007, there was a big recession, there was a big crisis, but now that it's at that zero line, it's been there for 2009, all the way to 2015. They tried to raise them, they weren't able to, and all the way down to 2020. They can't raise those rates because there was no inflation. So if we add a new pane and we go to, what's the inflation? US CPI. I think that should, no,